be read in conjunction with our MD&A and financial statements, which can be found on both the Jamaica Stock Exchange and the SYGNUS Group's website. Additionally, if you have any questions during or after the presentation, please share them using the Q&A tab in Teams. We'll have this discussion segment after the main presentation where we'll look to answer your queries. I would now like to warmly welcome our presenter for today, Mr. Jason Morris, co-founder, Executive Vice President and Chief Investment Officer at SYGNUS Capital. He will be guiding us through the presentation this morning. Over to you now, Jason.
Hi, thanks, Nicolette, and warm welcome to everyone. Hope you all had a fantastic weekend and ready for the new week. So, as usual, I know that Nicolette said it already, that all the information being provided on this earnings call should be read in conjunction with the financial statements that were sent to Jamaica Stock Exchange and released to all shareholders, as well as the audited financial statements, because you will get a better understanding and context for the quarterly and 9-month period if you are reading full version of the financial statement with a lot of notes. Okay, that being said, without further ado, we're going to the summary, providing backdrop for the financial results. So there are 6 key items we want to highlight before we jump into the actual financial statements. And the first one is just, again, providing an update on how SCI is transitioning and how the business is being scaled in terms of core revenues. So core revenues has now grown to 13.22 million, above the 10 million threshold during a 9-month period, which is great because I think our target was to get to 12.5 million for the full year. So that line item continues to grow based on what the business is doing and how the business is structured. A key driver of the core revenues for SCI, as we have been saying for perhaps the last 3 to 4 quarters now, is the Puerto Rico business. And that Puerto Rico business, just in terms of context, it was restructured effective July 1, 2023, meaning we would have completed the integration of Puerto Rico inside SCI proper by pulling out the operational expenses that are related to the management, etc., out of the Puerto Rico business, keeping that as a separate business, and just having the Puerto Rico balance sheet being a pure financial asset balance sheet. So since doing that, come end of June this year, it will be 2 full years since that full integration and reorganization will have been completed by the Puerto Rico team. Over the last 7 quarters, the Puerto Rico business, Accent Financial Limited, would have generated cumulative net profits of 8.68 million. And when you take that in the context of how much net profit Accent would have generated in its previous 19 years in operation, it would not come up to 8.68 million. So just want to provide that context in terms of the fact that the Puerto Rico business, which is in a 100 billion economy, it's in the Caribbean, but it's a US territory. And therefore, SCI shareholders are getting the benefit from that acquisition where SCI owns 95.6% of that asset, even though the asset is not consolidated all the way up into SCI, right? The third thing I want to highlight is, okay, that acquisition was done the end of February 2022, right? What does that really mean for SCI shareholders? And the way to look at it is, if you look at the return on invested capital, so SCI would have taken about 26 26 million plus, right? In terms of the initial acquisition price, so 26.39 million is what SCI has invested in total in the Puerto Rico business. And this would include the original 22 million that was paid as the first payment, plus I think 2 million in earnout, plus SCI would have increased its stake in the business by buying additional shares as the opportunity arose. I think on 2 or 3 different occasions. So the justification for doing that is, well, the business is generate, well, for the 9-month period, the business would have generated 22.7% return on SCI's investment of 26.39 million. And this return level is actually does not include is not utilizing the valuation of the business. This is just Accrescent, the operating entity. What is the net profit that has been generated in the 9-month period? What is that as a return on SCI's investment? Now, if SCI decided to sell Accrescent to a buyer, obviously it would not be selling it at the value based on the 9 months net profit, right? We would do have actual valuation of the business. So the actual return to SCI is higher than that 22.7% that's being shown. So I just want to create the context for how to interpret the results. Moving on to the bread and butter of a private credit business, which is, well, okay, you have a private credit business, but are you able to deploy capital on a consistent basis? How much capital are you deploying? Because if you, for example, raise capital or you borrow money in terms of debt and you can't deploy it at a fast pace, then you're going to have a problem, right? So the platform so far for the 9-month period has deployed 78.47 million. And in the third quarter, would have deployed 25.63 million. Now, this is a little bit down on last year deployment figures, right? Because last year was a monster year, primarily because SCI itself, raised a lot of capital, substantially more than it has this year. Last year, this coming into the January period, SCI would have had 50 million in dry powder to deploy, while this year SCI would have raised 33 million in perpetual preference shares. So the difference there in terms of the amount of dry powder you have obviously affects the deployment. So, but the big message is there's no issue that SCI has in deploying capital, right? Their transaction pipeline is very strong, originating very strongly. The amount of deployment really and truly just depends on the amount of dry powder that we have. And of course, the Puerto Rico business, similar structure. Fifth thing I want to highlight is shareholder dividends. Would have paid out 3.2 million, paid and declared, because the last dividend was actually declared in February during the quarter, but paid in April. But we're combining those two figures over the 9-month period, nevertheless, to be 3.2 million. Now, what does this mean from a return perspective for investors? Going all the way back to private placement, those who are in the private placement, that 3.2 million translates to a 5.5% dividend yield. If you are an IPO investor, then for J dollars, 6.4% dividend yield, 5% for Jamaican, 5% for the US dollar. APO is averaging 5.3% if you came in the APO. And for those who look at the stock on the open market and are thinking, well, does this transaction make sense? The dividend yield there is about 7.2% at the current market price. So just trying to create context again for what the dividends that SCI is paying out really means. And by the way, this is the 14th consecutive dividend that has been paid / declared by SCI since it made its first dividend payment in October 2018 after going public in June of that year. Last thing, well, as an investor in SCI, what's the return that the company is generating, which is different from the stock price. Like stock price will move up and down. Obviously, when you want to exit and crystallize, that's the stock price you have to use for that. But in terms of what's the performance of the deployment of the assets on SCI's balance sheet, for the 9-month period, that would have been a return on average equity of 12.7%, and for the third quarter, it's 10%, which is pretty decent for a private credit investment company. Another way to look at return on equity, right, is to say, well, over the from last year March to this year March, what's the change in the book value per share, right? Because if the book value per share is going up, then that says that the assets on the balance sheet are creating additional value. And then how much dividends has been paid out, and you add those things together, those two things together should give you a back of the envelope computation. Or maybe you could say that perhaps another way to calculate return on equity or calculate return into the performance of the book of SCI from an investor point of view. So if you were to take the change in the book value in the NAV and add the dividend yield, and this dividend yield now would be the dividend yield on that NAV. So if you take last year NAV, which I think was 0.1220 US cents, US dollars, and then if you take the dividends paid out and divide it by that NAV and add the change in the current NAV, which is current NAV is 0.1307 versus the 0.122 NAV last year, then you're gonna get 11.6%, right? So what I'm trying to do by looking here is that's trying to place a lot more focus as we transition the business to international best practice to kind of start to reflect different metrics that highlight returns and performance versus just focusing on net profit figure, right? Because the question is that a shareholder or a prospective shareholder, what are the assets on the balance sheet generating in terms of percentage, in terms of returns, and what does that mean for me if I own the shares already, or if I intend to buy the shares, or even if I want to sell the shares. So that's the background. Now we're gonna jump directly into the highlights for both the 9-month and the quarter. So starting with the 9-month period first, net profit was 6.97 million, up 60.3% versus the 4.35 million for the similar period last year. And this net profit figure would have surpassed the net profit figure that was generated for the full financial year last year. So in 9 months, we have generated more net profit than the full financial year results. And again, the main driver for that is the performance of the Puerto Rico business, because the Puerto Rico business would have generated more net profit for its 9-month period than all of the 12-month period of last year. Now, if you just to back up a bit and provide some context again, remember that the Puerto Rico business is not consolidated all the way up to SCI. Basically, it's consolidated up to the level of the holding company that SCI used to purchase to do the acquisition, and then that value is fair value. We have to apply some market metrics to that, and I'll get into that in another 3 hours of slides, but just want to highlight. Total investment income was a new milestone, 13.22 million, up 25.4% versus 7.54 million last year. Net investment income 9.44 million versus 4.22 million last year. Again, another new milestone. Earnings per share as 1.20 US cents versus 0.74 US cents for the same period last year, and dividends per share 0.552 US cents versus 0.535 US cents last year. Just another highlight on the Puerto Rico performance. Well, I kind of went through the return on invested capital on the first slide, so I won't deep dive too much into that, but I want to show it to you on a chart in about 3 slides time so that you can get, a good appreciation for what we're saying. Now for the quarterly results, net profit was 1.84 million, and that was down 11.2% versus 2.07 million last year. And again, here, this was primarily driven by the fact that the main mover here in terms of the Puerto Rico investment income was down primarily because for the similar period last year, down marginally for the similar period last year, the Puerto Rico business would have written back, so it would have recovered from a bad asset, which was, so they made provision would have made provision during the course of the year, and at the end of the year, they would have recovered from that bad asset. So we did a write back to the credit loss. While this year we don't have any recovery like that. We just have normal provisioning when you put an asset on the balance sheet. And so that main factor meant that the translation of Puerto Rico credit fund investment income down marginally, which affected SCI's net profit figure. However, from a total investment income point of view, in terms of top line revenue, that was 4.48 million, up 32.1% versus 3.39 million last year. Net investment income was 3.02 million versus 2.16 million last year, up 39.5%. And earnings per share was 0.32 US cents versus 0.35 US cents for this same quarter last year. And then dividends per share was 0.276 US cents versus 0.263 US cents paid last year. Another highlight in terms of what would have driven the net profit being down 11.2% this year for SCI was the fact that in terms of expected credit loss on the Jamaica, well, on the SCI side, and the English-speaking Caribbean SCI side, we would have done 2 things in terms of expected credit losses or ECL. The first one is that we would have taken an additional 851.5 thousand charge in terms of expected credit losses, primarily driven by 2 things. The first thing would have been, we have a stage 3 portfolio company, has been stage 3 now for a while. During the quarter in March specifically, we would have moved against the assets of the company, and we got those assets, have them in our possession, and based on the assessment of those assets and collateral, would have taken an additional, I think, 361,000 charge during the quarter, and over the course of the 9-month period for that asset would have taken a charge of about 551,000, give or take, thereabouts. So that one asset would have increased our ECL figure substantially. 851,000 over last year is a big jump. But the second reason why this ECL figure would have increased was because as we internationalize the business more, we would have embarked on a process to enhance our internal credit rating model. We were using what you call a scorecard model, and the Puerto Rico business has actually been using a very sophisticated automated model called Moody's Credit Lens, and we started a process at the end, pretty much at the beginning of the 3rd quarter, where we would have remapped and rescored all the assets in the portfolio. So basically, we upgraded the internal credit rating model from normal scorecard model that most people use to Moody's Credit Lens, and effectively, we plug the financials of the firm into this model, and Moody's credit lens out a credit rating, and we use that credit rating to determine how a portfolio company is ranked and what kind of expected credit loss to charge against the asset when you add it on the balance sheet. So what this allows us to do as we internationalize the business, and as it will help us to access in a better manner international financing facilities when our credit rating is being done annually by Caricris. It will also assist us in that process and just make our business a lot more efficient, faster for us to do rating of new portfolio companies as we add them to the books. So this is just another step in doing that process. Of course, you have to do it. You have to do it at some point, and anytime you do it, the rating at the existing portfolio can go up and down. And in this instance, we have assessed additional credit charges. So that's a good process to add to the business as we grow and expand. Second thing that would have occurred is obviously we have some fair value instruments in the portfolio, and these swing widely. I think in Q1 we had a big jump of like $1 million to the positive side, and at that time I'd said that don't pay too much attention to this because this figure can move wildly. I think in the second quarter it moved. I don't remember what direction it moved in. I think it's kind of stabilized, and this quarter it has reversed, gone down 514.4 thousand. As you go through time, fair value gains and losses will fluctuate as we assess underlying fair value instruments, and as the inputs that are used to value the assets fluctuate based on market conditions. Next slide, dealing with this results of operations table. I'm obviously not going to go through this, but I want to highlight a few things. The first thing, which isn't being circled on the chart, is that I think in the 6-month period, the net interest income spread was either negative or very, very low, right? It was pretty much flat. You can see that for the quarter, right, the net interest income is 2.6 million versus 2.4 million. And for the 9 months, it's 6.7 versus 6. Almost flat. What I'm highlighting there, though, is that there was an improvement in the net interest income relative to, say, the 6-month and period, because we had indicated at the time that we had taken some bridge financing to bridge the capital that was raised in the perpetual preference share, and then we pay that out once we raise the perpetual preference share capital, because that bridge financing was at a higher cost capital, right? So we pay that out, and hence you see the improvement in net interest margin. So the main thing I want to highlight here, though, are just 3 different items. You can see Puerto Rico Credit Fund investment income 1.8 million versus 1 million for Q3, and I'm gonna kind of explain that on the next couple of slides. And 6.2 million versus 549,000 last year, and I'm gonna explain that on the next 2 slides. Fair value loss, which I spoke about, you can see that for the quarter 514,000 versus a gain of 229.6 thousand same period last year, and then 1.12 million for the 9 months versus 785,000 for the same period last year. And as I said earlier, that 9-month figure of 1.12, which is down, it was actually up like $1 million in Q1. So, you know, it's a volatile figure, which is why it's we in our MD&A here we put it below the line. So net investment income is a key thing we should all be looking at each and every time, because that's what pretty much pays the dividends. Impairment allowance, well, we have pretty decent effects again, obviously, because SCI is a US investor, and a US investor, it will always be have net US dollar on the asset side of the balance sheet, but as well, we have adopted a strategy of borrowing in Jamaican dollars and deploying that capital into US dollars, and by doing that, If the exchange rate depreciate, then the Jamaican dollars that we borrowed becomes cheaper to SCI, obviously, because you are when you pay back the Jamaican dollars, you need less US dollars to pay it back. So those are the things that I want to highlight on that page. Moving to spend some time on the next two slides. I think in Q1 we started spending a lot of time going through what does the integration of the Puerto Rico business mean for SCI and how impactful it would be. I think in Q1 we said that we expect that the Puerto Rico business is going to become bigger than SCI's business in maybe, I think we had set a timeline for 18 to 24 months. I think it's fair to say that it's probably going to get there a little bit faster than that. So again, for those who are seeing this for the first time, we're reading this chart from the bottom up, right? So at the very bottom, we have Accusent Financial Limited, Accusent Financial LLC, rather, which is the operating company. So that's the company that when SCI was doing the acquisition, that's the company that SCI effectively owns the 95.58. Well, that's the company that SCI took its money to try and purchase. That's a company that had that's operating and deploying capital across Puerto Rico and generating returns, right? And that's where we are saying that the return on invested capital for SCI is 22.7%, and that's represent the base return on the base earnings power. So this is actually the operating entity. So in the short term, when dividends are going to be paid by this company, then that 4.5 million is what dividends would effectively be paid from. So that's the operating entity. Now, if you go above that to SYGNUS Credit Investment Puerto Rico Fund, SCIPRF, that's a holding company that owns 100% of AFL, right? And when you translate the $4.5 million profit and take a few expenses, etc., that are in AFL, that are in SCIPRF, that's how you get to 4.2 million, right? The difference between the 4.5 and 4.2. Now, there's a holding company above SCIPRF called SYGNUS Credit Investment Puerto Rico Inc. And that's the holdco that SCI used to do the acquisition all the way down to get to Accusent Financial Limited, right? So at the 4.2 million holdco level, we have to do a valuation of that figure because the consolidation stops at SCIPRF. So that 4.2 million figure, when you do apply the market multiple valuation metrics, it translates to 6.23 million. Now, you might be a skeptic and say, well, why are we valuing something that's 4.2 at 6.23 million? Well, if you look at last year, March 2024, we had the opposite problem. So last year, March, we had 3.08 million net profit generated by the operating entity. Then when you filter that up to the holding company above that, the difference was very minor, 3.07 million, which is normal, right? However, when we had to do the market valuation of what that 3.07 million translated to, which is what's going to come through to SCI's income statement, it came out to 594.6 thousand. So 3 million at that time gave us a huge disadvantage because even though the company made 3.08 million, only 594,000 flowed up into SCI's financial statements. And the difference there is 2.something million, as you can see, right? This time, the company has generated 4.2 million at the holding company level, or 4.5 million at operating level. And when you do the market valuation, depending on where the market multiples and metrics are, it translates to 6.23 million. So we are saying that the value that comes through SCI's income statement will fluctuate from time to time at the margins. But if you were to look at it over, say, from we started this process July 1, 2023 to now, we are pretty much in line with the amount of net profit generated at the operating entity. And obviously, when dividends start to be paid to flow up back up to SCI investors, which should be, knock on wood, sometime in 2025, then the figure that will drive the dividend is going to be at the AFL level. So I hope that was clear for the 9-month period. Now we can shift very fast and go to the Q3. Effective in Q3, the operating entity made 1.43 million related to 1.74 million last year. And the main thing driving that, as I said before, there was a chargeback in terms of credit losses that were recovered in the similar period this time last year. While this year we didn't have that, so obviously we have a higher charge. Every time you put an asset on your balance sheet, you need to provide for against it, right? So we didn't have anything that we recovery for this quarter. We also would have made slightly lower, had slightly lower sales and assets. Now my Puerto Rico business actually originate transaction and sell them, collect a margin on that, and then recycle the money. And that activity was a little bit lower during this quarter. So you take that 1.43 million, send it up to the whole co, it translates to 1.33 million, and then when you do a valuation of that, it come out to 1.8 million based on where the market is, right? And as I said before, if SCR shareholders were to actually sell the business, we would actually be looking at that 1.8 to apply some multiple to that 1.8. Going very quickly in terms of efficiency and management expense ratios, these were well within the target threshold set by the company. Again, efficiency ratio is just saying for every dollar of revenue generated, how much of it goes to operating expense. You want that figure to be very low because that means you have more money to pay out dividends or to invest. And same thing for it when you measure it as a percentage of your assets under management. From a balance sheet summary perspective, shareholders' equity now at 75.86 million, a new milestone, up 7.1% over the similar period last year. And as I said before, this translates into a 12.7% return on average equity. And when you take the dividend yield and APO and IPO, they are above 5%, which is pretty decent for a US investment company. And obviously, as we go through time, our intention is to increase these dividend payouts. Because all we are doing is taking money, deploying it into private credit instruments and investments, and then get that money back, pay out dividends, and redeploy the capital. And that's all we are doing constantly. And we're just building out the business as we go through time. Right? Total assets would have achieved a new milestone of 228.41 million, up 15% versus last year. KPIs on the balance sheet, debt to total assets, 0.48 times, within the limit that we have set for ourselves. Asset coverage ratio at 2 times. Again, within greater than 1.5% threshold. And the asset coverage ratio, again, just for those who may not be coming here for the first time, this is a ratio that says how fast or how much assets do I have that I can convert to cash very quickly to pay down debt if, for example, financial markets were closed or, there's a crisis on the horizon. It's very important for a private credit business. And as you can see, SCI is very lowly levered relative to, say, other financial entities like a bank, right? That are levered between 8 times and 10 times. These are very low leverage business. Net debt to equity 1.06 times, up marginally from 0.81 times last time versus what you would get 5, 6, 10 times for banks coming at a bank. And then non-performing investment ratio 0.6% versus 0.8%. Now moving to summary of investment activity through the first 9 months of the financial year. Investment in portfolio companies 214.6 million. But this figure includes the equity investment in the Puerto Rico business, the main Puerto Rico business that we went through earlier, of 34.9 million. And we would have made 1.49 million. Well, we have 1.49 million exposure in Puerto Rico to a new impact fund, which has started to do some business there. It's doing okay. So as we go through time and this becomes a bigger transaction, we will provide additional updates on that. But this is just another way in which we are scaling and enhancing the business by deploying capital into various areas of the Puerto Rico economy to generate the returns, to bring back to SCI shareholders, to diversify the asset base of SCI and to scale the business. Portfolio company investments at 38 versus 35 last year. New commitments would have gone through at already 37.48 million, down from the 47.02 million, primarily because SCI itself actually had a lower pool of capital to deploy from last year. We outdid ourselves by raising 50 million in dry powder. Portfolio yield 15.3% versus 14.8%. We expect that yield is gonna start to trend down as interest rates start to slowly go down. Average tenor 1.4 years versus 1.6, and dry powder 5.38 million versus 11.31 same period last year. Just a quick note here that we continue to advance discussions with international creditors for additional facilities, and I'll go through that in the outlook. In terms of exits, we have done 19.28 million in exits versus 27.61 million last year. Just based on how many new transactions we put on last year versus this year. Risk management. Looking at this chart, key things is that we still have 2 portfolio companies in stage 3. I think I've spoken about one of these portfolio companies that went into bankruptcy. We have a pretty good handle on what's going on. Still last mile going through the courts. We expect in terms of the collateral that we have and payout from the company to recover our investment. Hopefully I can come on here when we are going through the audited financial statements at the end of August / first week of September, and that matter would have been settled. The other one, we would have taken possession of the underlying collateral, which is the point I had gone through earlier, and we would have taken additional write down on the asset based on what we think is the state of the collateral that we have in our possession. Stage 2 asset, if you look at the chart, you see that last year we had 1.34 million US in listed as stage 2, and this year there's 0, and that's because the company would have paid us out, and so that's the reason why there's nil this time. Kind of went through the change in ECL earlier, so I won't spend too much time there, but if people have questions they can ask. So move to the next slide, and this is just showing the historical trajectory of our expected credit loss reflected on the balance sheet as a percentage of the overall portfolio. It moved from 1% at the end of December to 1.4%, primarily based on the 2 items I spoke about earlier, which is the additional charge taken on the stage 3 asset, whose collateral we have seized, and we are prudently taking an additional write down on that, and the change in the credit lens internal rating system, which would have re-rated and remapped the entire portfolio, which have resulted in slightly higher ECL charge. And just for context, the crystallized realized losses of SCI since inception in 2017 is less than 0.3% per annum. Portfolio allocation by industry. Not gonna spend too much time here. Nothing much has changed in a major way, but you can see that, well diversified across 22 different industries. When looking at the overall portfolio, including the Puerto Rico business. And if you look at it from a per region, Puerto Rico remains the larger exporter footprint at 32.3% versus Jamaica at 24%, Bahamas at 14.9%, followed by St. Lucia at 30.1%. Now to the last slide. What's our strategy? I think our strategy is pretty clear, right? one big thing that we stated to shareholders at our annual general meeting earlier was that we want to scale the Puerto Rico business. It's $100 billion economy. As you can see what's happening in the world today with tariffs and geopolitical uncertainty, etc., Puerto Rico actually isn't suffering from those effects per se. There's earmarked capital over 50 billion US for infrastructure build out, given that Puerto Rico came out of default in March 2022, a month after we would have closed the acquisition of Accent Financial, right? So I guess we had a lot of luck in terms of the timing of doing the acquisition and would have increased our stake in the business. And you can now see the reason and rationale behind why we would have increased the stake in the business, because the business is firing on all cylinders. Dry powder, that Puerto Rico business has more dry powder than SCI, again, due to the fact that they are in a much bigger economy and the way that credit operates in that neck of the woods is very different from what happens in the English-speaking Caribbean. That being said, SCI is still pushing to try and get at least half of the credit lines that Puerto Rico business has. Puerto Rico business has $100 million credit line, which is more than 10 times larger than SCI's credit line. So Puerto Rico business, very clear strategy: grow the business, try to become #1 in Puerto Rico. It's right now based on volume of transaction, you could say we are thereabouts, it fluctuate between 1 and 2. SCI, second strategic pillar, the growth path for SCI. As we said before, we want to participate in over $1 billion of private credit transactions. I think we are given a timeline of 3 years. We are north of 500 million. And so that remains in progress. We'll continue to push. Obviously, we need additional dry powder in order to keep doing that. Core revenues, I think we're targeted to the end of this year to get to 12.5 million. We're now 13.22 million in 9 months. So that's going well. Return on average equity, I think we had wanted to be at 10% ROE, and for 9 months we're at 12.7%, and for Q3 we hit that 10% target. So it's been a while in coming. We're getting there, and hopefully we can continue this through to the end of the financial year. EPS, we're at 20% annual growth rate target for the year, and for the 9 months relative to the end of last financial year, EPS has grown by 16.5%, but that's not a year-over-year figure. It's just year to date. So it's the 9-month figure compared to what the 12-month figure was last year. I think if you compare it year over year, the EPS this time last year was like 0.74 US cents versus what it is now, which would be multiples of, would surpass the 20% if you did the comparison that way. But year to date, we are tracking at 16.5%. So as long as the last quarter makes a profit, then we should get very close to that 20% rate or exceed it. Dividend yields, we said in steady state we wanted to have a floor of 5% on the APO price, because that's the last time that we raise ordinary share capital. And I think the weighted average yield between J and US is 5.3%. Obviously, this is just a minimum, right? This is not a target. So we want this to build to go to 7 and 8% over time as the business expands. That being said, yield on the stock is 7.3% as at May 2016, which is a reflection that the price has gone down, right? And I keep saying all the time that, but I don't have anything more to say than that. I think I've said it all at annual general meeting in terms of the way our market operates. I mean, you can go and buy SCI shares in the market today and collect 7.3% in USD. think that is self-explanatory. You don't need to kind of like explain that. 100 million dry powder. This is a revolving door, meaning this is not a target where we have a one-time target to raise 100 million. This is like every year we want to have 100 million in additional dry powder. So that's what this is transitioning to. We know that we would have signed up and gotten approval from World Business Capital, which is guaranteed by Development Finance Corporation of the United States for a $10 million facility. That trail went kind of cold because of all the changes that would have happened with the new administration. I'm happy to say that things have started to move in the right direction again, and we are seeing where there's an opportunity, a possible opportunity for this to come back online. So we are opening back those discussions to see if this will be the case, or I should say when this will be the case. So as soon as we get additional information on that, we will provide you with an update. But it does appear that this deal, which the only thing that was left is for effectively disbursement to happen, right? So we will see whether or not there's a chance of this happening sooner rather than later, and if so, we'll promptly provide a release to shareholders on the stock exchange. Of course, we have done the dual currency capital raise, completed during the quarter in January. That's behind us. That was a good transaction, but that's behind us. We are now looking forward, and we have started new discussions, speaking with 2 prospective partners. We have another prospective partner that would have opened initial discussions with. Those discussions were put on hold for a time, but we think that this transaction may come back on stream, I would say before the end of the financial year. So the long and short of it is we are pushing very hard because we need 100 million kind of line, right? SCI operating in a framework where we are borrowing, going to market and borrowing, raising capital and putting on the balance sheet and then taking time to deploy the capital is not efficient. It's good, but it's not very efficient because we have a negative carry or negative return during the period when we have the liability on our balance sheet with the interest expense, but we haven't 100% deployed out the capital, because you can't deploy the capital the first day after you borrow the money, right? The efficient way to do this is to have a mixture of different forms of capital, including a very large access to a very large revolving credit line where you can draw $10 today, fund a transaction tomorrow. When you exit the transaction, you pay back the $10, and if next week you have another $10 transaction, you draw on it again, fund the following day, and you keep doing that. And what that does, it prevents you from having this higher interest expense that you would have had on the full $10 from day one, while you don't have full $10 invested from day one. Third thing, we are looking at additional ways. I would have mentioned this last quarter, so we would have made substantial progress with a new business that we're rolling out as a dedicated financing solution with a strategic partner. Would have reached a critical milestone subsequent to the end of March, to the end of the quarter. So we are excited about this new opportunity, and we will provide more information on that. And final thing on share buyback, we didn't do any buyback during the quarter, and obviously whenever we do, we will advise you thereof. Thank you very much. We'll now take your questions.
Thank you for that detailed walkthrough, Jason. I'm sure the listeners and investors can appreciate the clarity that you've brought to our performance and our trajectory. I see that we already have a few questions, but before we jump into the question and answer section, just one more reminder that if you are on the call or listening via YouTube, you can share your questions via the Q&A tab in Teams or our YouTube chat, and we'll get to them. Now to start, we have a few questions from A. Johnson. The first one is questioning SCI's dry powder. If you can elaborate a bit on the pipeline of investment opportunities that we might have and how liquidity constraints may impact near-term deployment.
Thanks for that question. A very good observation, excellent question. So, I mean, right now we have across the platform 10.4 million. When I say platform, I mean Puerto Rico and SCI combined. 10.4 million we had 10.4 million approved transactions that weren't funded as at the end of the quarter. And SCI proper itself had 3.3 million of transactions that the drawdowns hadn't happened, right? Now in terms of pipeline though, I mean, I would say SCI have at any given time and right now using just like a 60-day projected pipeline, because we normally don't project much beyond that, right? We have, you know, more than 50 million in pipeline transactions that can crystallize, right? In terms of how we're gonna fund that, apart from the dry powder that we showed that was on the balance sheet, right? Is that we have quite a number of exits that are coming up. So we have investments that we are exiting that will give us liquidity, which we will recycle, which is substantial. I think we have we should have north of, I would say 20 million or so, if my math serves right, in exits that we will be recycling. And from time to time, we have access to bridge financing that we can utilize, you know, which we will tap into. So that's how we intend to fund that pipeline. We spoke about the $10 million DFC facility, which we hope will come back on stream. Of course, if we're betting person not making any bets, but hopefully this will come back on stream, say long before the end of the financial year, or I would say before the financial year end, which is June. So if that comes on stream, that's an additional source that we can tap. And of course, we are in discussions with more than one partners looking at 50 million and above facilities. But those aren't anywhere as yet, right? We don't have any firm term sheet or anything like that as yet. Early stages of discussion, but we are looking at those type of facilities. So I think we will be in a good place. The pipeline is strong. Our liquidity is okay-ish at the moment, but we are working feverishly to bring in additional liquidity to ensure that we can continue the growth. In the Puerto Rico market, they don't have a liquidity problem. They have a good amount of dry powder to fund their sizable pipeline. I hope I've answered the question. That was that.
Okay, thanks, Jason. E. Johnson's second question: in a hypothetical rate cut cycle, how sensitive is SCI's yield on investments in portfolio companies to declines in the Jamaican or the international financing partners' interest rate?
Another exceptionally good question, right? So let me start with SCI first. So the way our SCI business operates, SCI, so when I say SCI, we're not talking Puerto Rico. I'm going to go to Puerto Rico second, right? So SCI invests on a fixed rate basis and also borrows money on a fixed rate basis. So if rates started to come down, given the average 1.6 years of our average tenor of our portfolio, obviously in about close to 2 years' time. As the portfolio rolls off, so back up, because we have an average life of 1.6 years now, obviously we have some time within which to buffer against falling rates, because the falling rates will apply to new investments that's going on to the balance sheet, right? Of course, 1.6 years isn't a very long time period, but we still would have some buffer. But at the same time, in terms of SCI's borrowing, any new borrowing that we're doing would be at lower rates, so that would be positive. On the negative side of obviously, as we put our new assets at the lower rates, then it means that our yield will come down and we would still have some amount of borrowing left at the higher rates. But based on our maths, the impact on our portfolio, which is over 200 million, well, over 184 million if you exclude the Puerto Rico business, but if you include the Puerto Rico business, over $200 million, the impact will be small currently, and it would be small especially with regards to the fact that the Puerto Rico business, right, actually invests on a fixed rate basis, but borrows. So the 100 million credit line that Puerto Rico has is actually a variable rate credit line. So as interest rates come down, that business is gonna start to show a bigger margin, right? Because its book is in fixed instruments, but its liabilities are variable. So as rates start to come down, the liabilities are gonna reprice much faster than the asset side, and that will increase the spread. So that's what we think is gonna happen. We have been, of course, we started the business in a very low interest rate environment when interest rates were close to zero, and we made some pretty decent earnings during those times. I think what will also happen is that some of the fair valued instruments, and we have about 26.7 or thereabout million in fair valued in assets on the balance sheet that we have to fair value. Some of these assets, actually, the way we structured the notes, we structured like convertibility in them. So let's say a company is gonna do an IPO or have some other type of market-driven liquidity event, then we have prospective upside to get from those, meaning when the IPO happens, we can convert the debt to equity, but get taken out at the IPO price. So we're not holding beyond the actual IPO value being crystallized. But if rates come down, it means that those companies may get a higher valuation, and that would benefit SCI. And final point is that if rates come down, the Puerto Rico business would also be valued more. I think the valuation of the business has been depressed because interest rates are high from a historical point of view. So I think, and of course, as you know, SCI could one day choose to sell a portion of the Puerto Rico business if it so desired. And obviously, the multiple at which it would sell that business would be, we'd only do that if we are getting a very good value to bring in other investors. So it's a complex question, but from our point of view, we think that SCI is built to make to grow substantially, whether rates remain high, go higher, or they come down. Temporarily, we may have a re-rating of what happens with profitability, but because we are in the business of taking capital and then making a spread on that capital, then we won't be impacted too much. Our objective is to make around 500 basis points spread. So I think we'll be able to do that no matter the environment in which we're in. But excellent question and observation.
Okay, final query from A. Johnson, and this one is related to the dual tranche perpetual preference shares. It's a two-tiered question. So The first query is, with the 15-year non-call period, does management view this structure as potentially margin dilutive in a lower interest rate environment? And also, how does this align with SCI's long-term cost of capital strategy?
Another exceptionally good question, right? Very good question. So if you think about the perpetual preference share, right? If rates start to come down, then obviously one could start to say, well, the cost of that capital is expensive, right? So that's one view. But ultimately, if SCI thinks that the cost of the capital is expensive, then the simple solution to that is to leverage that capital, right? Because effectively, that capital is equity, or should be treated as equity by SCI. So if I leverage that capital with the cheaper cost of borrowing that is occurring because rates are coming down, then that's how we mitigate against that in an environment where interest rates are coming down. From our point of view, that perpetual preference share represents an excellent additional capital buffer to allow SCI to enter certain relationships that we couldn't enter. So for example, us trying to get $100 million credit line without the perpetual pref share, right? Our share capital would be 60 million. So the question is, what is the value to SCI shareholders and to SCI of being able to go and harness $100 million credit line, which is very difficult to do when you don't have 100 million in, as we have seen over the last 5 years or so that we have been talking about, right? We have been talking about this for a very long time. So if we take an action where at the margin, the dividend being paid out on it is quote unquote disadvantageous because rates are coming down, that has to be offset against the fact that if I am able to raise 100 million in revolving credit line at very cheap rates, then that benefit of 100 million versus 33 million that is perpetual raised at whatever the cost of perpetual is gonna far outweigh the disadvantages. One. Two, bear in mind that a large portion of the perpetual is actually J dollars, Jamaican dollars, right? So right now today, as I'm speaking to you, if you look on the income statement, you see net foreign exchange gain 261,000 for the quarter and 254,000 for the 9 months. That FX gain, roll up in that FX gain, is the fact that on the liability side of the balance sheet are Jamaican dollar perpetual preference shares and non-perpetual preference shares and debt, right? So on the liability side, I raise capital in J and the currency depreciate. So let's say the rate that I raised it at was 10% and the currency depreciate by 4%, 5%, 1%, whatever you figure. My cost of capital is going down, right? Each year the currency, although Jamaican currency has been really depreciating, if we're being fair. Just recently that it's been moving in a band. So I'm saying, if, as we go through time, that's another benefit that SCI gets from the perpetual preference share. So what I'm saying in a nutshell is all the benefits that the perpetual preference share brings, our ability to much larger pools of capital and get, let's say, revolving credit lines, our ability to go and speak to international investors, because maybe before our capital base was too small. They're like, yeah, you're doing well, but at the end of the day, your total capital is X. Now that we have the perpetual preference share which forms part of our equity capital, we can have those conversations and execute a transaction and the benefit of executing transactions like that, and the benefit of raising a large part of that capital in Jamaican dollars, given the environment that we are in, far exceed and outweigh the fact that if rates come down, one could say, well, we should have waited and raised the perpetual at a cheaper cost. So that's how I would answer the question. I hope I have not, skirted around it and have answered it. But that's the way we think about it. We don't see the perpetual pref and the cost of it as bad. We see the benefits from having the perpetual pref at the time when we did the capital raise as substantially positive for SCI.
Okay, moving on to a question from Ryan Thelwell. You addressed this a bit, Jason, but is it more challenging for SCI to receive funding from international lenders, mainly due to global economic uncertainty related to tariffs in the US?
Nah, that tariff not having any effect on SCI whatsoever. So just to give some context, and I can give this context because SCI has actually undergone due diligence, or I should say is undergoing due diligence from a minimum of 1, 2, 3 different, what I'm gonna call multilaterals, right? As part of various transactions. And that's not an issue. What international investors are looking for, as well as international private investors, right? So SCI has done over the last 18 months, and in particular over the last 2 months, and continuing tremendous amount of due diligence with multilaterals. So, and there's no challenge. The issue is always, well, another issue, as I said before, scale, right? Scale is very important. And we would have addressed that scale problem with the perpetual per share, I think, in my judgment. Ability to deploy capital, so origination, they want to see your ability to originate. The risk management framework that you have in place, they want to see strong governance and risk management framework, all of which SCI ticks those boxes. Tariffs, in a perverse way, might actually be beneficial to SCI. Why? SCI operates in the Caribbean. The Caribbean has 10% tariff on exports, right, of goods, while other countries have much higher tariff rates. So in a perverse way, the Caribbean actually can become, I don't want to call it a transshipment point, but can become a hub that monetizes global trade more effectively from those governments and businesses that are willing and able to make good use of the opportunity, right? Because if they are tariff of 20% somewhere else and we have 10%, we have the lowest base tariff, right? So it's an advantage to us. And in the case of Puerto Rico isn't being impacted because I said before, the Puerto Rican economy, which is big pharma, pharmaceutical, and pretty much just infrastructure investment. For the next 5 years, Puerto Rico is all about building out roads, bridges, power supply systems, lots of houses. That's what's happening, and pharmaceutical companies. In fact, Puerto Rico also is likely to benefit from nearshoring operations, where US entities that have offshore operation needing to bring back a larger percentage of their operations nearshore. And because Puerto Rico has a very advantageous tax system, we might see increased activity. So to answer your question, tariff doesn't come into the conversation when SCI is seeking financing. The things that come into the conversation are around governance, risk, and ability to originate, structure, and deploy capital. Those are the things that that everyone wants to see. And I'm happy to say that so far, all of the due diligence SCIs are undergone, and we are undergoing one at the moment. Those are the things that are front and center. Tariff doesn't enter the conversation.
Okay, another question from Rayon. How long do you expect the timeline for the disposal of the assets that were seized from the charge-off entity?
Well, it's a good question, you know, and I don't have a crystal ball. These things take very long to be resolved. We remember that we have a 1 million exposure that got settled in inverted quotation, and even now we haven't gotten them paid out as yet because there are so many things going on, right? So at this stage, once you enter any sort of discussion, these will take a while. The difference here, though, I think, is because we are the ones in possession of the assets. Then that makes it a much quicker process, right? But that being said, we don't know what kind of hurdles exist on the horizon. So I don't want to make any prediction, simply because it's an unknown. And I'm being honest. As soon as we have more firm information, I'll provide.
Okay, a few questions from the YouTube chat. There's a few queries from the Limitless podcast related to the share buyback program. Primarily, what factors beyond the share price and the discount to NAV influence the decision making regarding when to repurchase, and has the board formally reassessed the buyback pace given the discount and the time remaining?
So to answer the last question first, the buyback pace has not been reassessed. And the first part of the question, we buy back the shares when it's opportune to do so. So when it's opportune to do so mean, okay, the value, the amount of shares on offer in the marketplace, as well as, well, how much liquidity do we have? Do we use that liquidity to buy back shares today, or do we use it to fund a pipeline investment, because our pipeline is so large and our liquidity relative to the pipeline is so small that it doesn't make sense to buy back shares until we have a bigger liquidity on hand. So those are the things that come into play, right? So it's an art. It's part art and part science. We know where the price needs to be when we need to buy back, but then at the same time, okay, how much liquidity do we have? Should I spend $1 million US and buy back shares, or do I need to save this $1 million US because there's a transaction over there that's gonna give me 15%, and that transaction actually has, on top of the 15%, it actually have additional upside on it because the entity might do an IPO in 3 years, and we're structuring, or we rolling out a new business line. We thought that the rolling out a new business line would have taken a year. It's taking 6 months. So it's much shorter, and things are moving fast. So should I take the liquidity and buy back the shares, or do I put it in and capitalize this new business line? Because the projected return on my investment is 15, 16, 20%. So what I mean? So those are the things that go into decision making. And we have already provided in the Outlook section how many different things we are working on to scale the business. So it's not that we don't think that the price is cheap enough or anything to do with reassessment. It's just a question of priority. If I have $1 to spend and I can only spend it on 2 things, but I have 3 things to spend on, I'm going to have to pick the 2 things that I want to spend the money on, right? But that's what's happening. And because the share buyback, we have a long lead time. Yeah, it's not like share buyback is gonna finish tomorrow, right? So it will still be there. We need to take opportunities to enhance shareholder value when we see them, and the enhancement of shareholder value at the moment is in doing investments which will generate 15, 16, whatever percentage return on the invested capital.
Okay, another question from Rayan. Recently, SYGNUS Capital announced that it is expanding in Puerto Rico with the launch of the Advisory Services Unit. Will this benefit SCI or Accrescent, and if yes, how so?
Well, I mean, indirectly, obviously, SCI's name is SYGNUS Credit Investments, right? And SCI's business in Puerto Rico is SYGNUS Credit Portal. So what I mean? So by launching that business, the brand name of SYGNUS gets bigger in the market. And so if we were to go to investors and say SYGNUS Credit Investment Puerto Rico is doing A, B, C, or D, then the brand recognition imbued to SCI. Of course, SCI is not paying for that brand recognition. It's free. So yes, as well as, obviously by having that business, SCI will forge additional corporate relationships, which ultimately will just increase the ability for SCI to originate transactions or to forge partnerships or to do, to enter into business transactions that may otherwise not have come if that business wasn't there. So the short answer to the question is it will indirectly benefit SCI, but not directly in terms of SCI not earning money from it or anything like that. But certainly, the more brand recognition that the SYGNUS brand name has, the better SCI will be. Because, for example, when international investors are doing due diligence, they do the due diligence on SYGNUS. They do due diligence on SCI as well, but ultimately, right, they're doing SYGNUS due diligence. They're like, okay, who's this firm, SYGNUS, blah, 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 blah. After they're satisfied with that, then they come down and say, okay, this private credit fund, SYGNUS Credit Investments, let me do the due diligence on them. And that's how it works. So ultimately, any such expansion of the SYGNUS footprint anywhere in Caribbean / Latin America / USA will be net positive for SYGNUS Credit Investments and the shareholders of SYGNUS Credit Investments.
Okay, question from Philip. What does the 0.6% non-performing investments ratio represent specifically in relation to the whole portfolio?
That just represent the percent of the companies that are non-performing or stage 3.
Okay, another question. A number of countries listed in the portfolio allocation by region are heavily utilized for incorporation by IBCs. Are these facilities being disbursed to companies incorporated or actually operating in these regions?
It's a good question. Excellent question. So it's a mixture of both, right? Because you have companies that are incorporated in one region and they operate across multiple regions. and we have quite a few of those. But in other instances, some of the IBCs, so by and large, I would say if I were to just run down the list, so majority of the IBCs are probably those holdcos that are operating across multiple Caribbean territories. So I hope I've answered the question. But in other instances, like companies that are incorporated in Jamaica, they're not just operating in Jamaica. They're operating in multiple regions. Companies incorporated in Barbados, not just Barbados, multiple territories, and so forth and so on. So there's a mixture of both.
Okay, a few more questions from YouTube. First one is from Ryan, and Ryan is asking if we have any timeline now on when we plan to come back to the market to raise funds for future growth.
Not at the moment. There are no plans that I can think of at the moment per se. I mean, the SCI may like private placement market, which is a normal course of doing business for SCI anyway, right? But in terms of like, okay, to do a preference share or to do like, let's say a JSE type capital raise, I wouldn't expect that to happen over say the next 1 or 2 quarters. But of course, the possibility exists for that to happen at end of the year into next year or so. Yeah, I think at the moment probably more than likely be private placement market for now, and of course pushing very hard to get at least one of those credit lines or one of those international financing facilities to come in.
Okay, Jason, a question from David Rose, also on YouTube. He's asking if you could give a bit more context on the WBC funding and the current status.
Yeah, so as I said before, right, that transaction was done. The only thing that was left to do was for it to be dispersed. But based on all the changes that happened, it got frozen in time, and we think that there's an opportunity for a thawing of the ice, and so we are received an update last week, which could mean that the transaction may be back on, but it would just be a matter of the timing of it. And so I don't have any other information than the fact that we have some discussions slated to see what the timing would be. Because the way some of these things work, if you have a pause and then you have a resumption, then there's going to be a queue, right? So there's going to be a queue. And so the question is, which transaction is at the head of the queue versus which transaction is at the back of the queue, kind of thing. So I can't provide any timeline other than to say it like that. Obviously, we would want to be at the front of the queue or as close to the front of the queue as possible. But these things are very fluid, you know what I mean? 1 minute it can be this, next minute it can be that, but at least we think that there's some movement, and that where we are now is that there may be a queue, and we have to figure out how we get as close to the front of the queue as possible. So that's where we are. And as I said before, if I get additional information, it will be published on Jamaica Stock Exchange instantly.
Okay, thank you, Jason. That seems to cover all the queries that we have currently. So thank you for the clarity that you provided with those additional questions. I'd like to take this opportunity to remind everyone on the call that the recording as well as the presentation deck will be available on both the SYGNUS Group website and YouTube after we conclude this call. Thank you once more for taking the time to listen and interact with us this morning. If you have any lingering queries, you can reach out to us via info@sygnusgroup.com and someone will definitely respond to your query. So I'd like to wish everyone a productive rest of week. Goodbye to you all.